Global Business and Economic Focus, the 5th of July 2026. The global economic outlook remains uncertain as major international institutions offer differing views on growth prospects for the year ahead. While the International Monetary Fund recently raised its forecast, the World Bank has taken a more cautious stance, lowering its 2026 global growth projection to 2.5%, down from 2.8% earlier in the year. The downgrade reflects ongoing geopolitical tensions in the Middle East and continued concerns over energy supply disruptions, particularly around the Strait of Hormuz, with average oil prices now expected to reach around $94 per barrel. Economists also warn that the risks remain significant. Should major oil supply routes face prolonged disruptions beyond July, crude prices could climb to as high as $115 per barrel. Such a scenario would place renewed pressure on the global economy, slowing growth sharply while reigniting inflationary pressures across many regions. In equity markets, investors are beginning to rotate away from some of the biggest U.S. technology companies. Although July has traditionally been a strong month for U.S. stocks, analysts say the second half of 2026 could prove more challenging for the technology sector. Companies such as Microsoft and Meta Platforms continue to invest heavily in artificial intelligence infrastructure, with those sizable capital commitments placing pressure on free cash flow and encouraging investors to seek opportunities in more defensive sectors as well as selected European small-cap companies. Europe's technology sector, however, continues to attract investment. Private equity firm Bridgepoint has led a €200 million funding round for French artificial intelligence human resources platform Skello, supporting its plans for expansion across Europe. Meanwhile, Uber is reportedly scaling back the expansion of its food delivery business in several European markets, including Austria, Norway and Greece, as it focuses on increasing its strategic investment in Delivery Hero. Commodity markets are also attracting close attention. Gold is attempting to stabilize after a difficult June, during which the precious metal fell by around 11%, leaving prices significantly below the highs reached earlier this year. The decline has been driven by persistently high global bond yields and expectations that interest rates will remain elevated for longer. While July has historically been a favorable month for gold prices, market sentiment remains divided. Some investors continue to view gold as a traditional safe haven asset during periods of uncertainty, while others are increasingly treating it as a liquidity-sensitive investment influenced by broader financial market conditions.